Hello all, this is Akshara Menon from PMS Bazaar. A warm welcome to all the participants. And today our topic is power of factor investing and how AI can enhance allocation. We all know factor investing focuses on specific trades impacting asset performance. And AI enhances this method by swiftly analyzing the data, identifying the connections, and optimizing the factor allocation. This AI-driven insights help the investors to make more informed choices for potentially improving the portfolio in performance in dynamic market. To have a more brief talk on it, we have Ms. Sonam Srivastava on the call, a globally recognized quant researcher with 10 plus years of experience in HSBC Edelweiss. She is an IIT Kanpur graduate who built a 400 crore successful advisory using quant strategies, which she believes can revolutionize the PMS market as well. Welcome to the show, ma'am.
Thanks a lot for having me, Akshara.
Yeah, and two line about Wright Research would be Wright Research is a wealth creator in digital space that uses scientific data-driven methods to tactically extract the opportunities across the assets in the public market to grow clients' wealth. Without taking much of your time, I would like to hand over the podium to Ms. Sonam. Over to you, ma'am. But before that, I would request the participants to put their question on the Q&A box and not on the chat box, and not to ask any stock-specific questions. Over to you, ma'am.
Yeah, thanks a lot, Akshara. Thanks for the introduction. And thanks a lot, everybody, for joining me on a Friday evening. Today, we're going to cover a very exciting topic, right, which is factor investing. I have a short presentation prepared for you guys, and then we will move on to, talking about, doing your Q&A and, answering any specific questions that you guys might have, right? So to begin with, I'll talk to you a little bit about my journey and, what Wright Research has been up to. I think Akshara introduced it really well, but I'll give you a short introduction anyways. I'm Sonam Srivastava. I'm IIT Kanpur graduate who worked in the financial market doing algo trading and quantitative investing for 10 years before I started Wright Research, right? And with Wright Research, we've been working in the advisory space for the last 4 years. We've got a lot of retail investors who have fallen in love with the quantitative philosophy that we talk about, right? And that is because, we use data-driven investing, which is highly objective, much more reliable. Second is that the performance on the advisory space has been very, very strong for Wright Research. So after 4 years of doing this, it made a lot of sense for us to take it out into the PMS market as well, because in the PMS market, we get to do end-to-end fund management for the client. Now, the PMS is 4 months old. We manage 50 crores in assets, more than 50 crores in assets. In these 4 years, we have around 80 people who have already onboarded, and we have a big pipeline of people who are in the process of onboarding. So very excited about, what we are doing, and we're seeing a lot of excitement coming in from the audience as well. So I'd like to talk to you about, what we do, what is factor investing, and where do we use AI in asset allocation here, right? So first thing is that, what are the core values through which Wright Research works, right? So first of all, it is multi-factor investing based on different factors. I'm going to explain what factors are in the subsequent slides. Second thing is what Wright Research does really well is momentum investing. So momentum is an extremely important factor in India, and we'll talk more about it. But momentum investing is something that we do really well and which has worked well for us. Third is that we use AI for risk forecasting, right? So risk management is again a big focus for Wright Research, right? So we know that a momentum investing strategy will do really well when the markets are good, but what happens when the risk in the market is high, right? So that is where we use AI to forecast the different market regimes to do risk management. And we, in some of our strategies, we even deploy hedging, right? So I'm going to cover all of this in detail in the next few slides. So we have 3 PMS schemes, which you guys can all see on the PMS Bazaar website also. The first scheme that we have is the Wright Factor Fund. This is a combination of multiple factors, right? It combines different investing themes to give you a robust return in any market scenario, right? And we tactically fine tune it. It's a very active strategy, so we don't buy a stock and hold on to it forever. We also tactically shift our allocations as the time goes. So this strategies in the last 4 months till now has given a 29% return, and it is 16% over the benchmark, which is BSE 500. Our other strategy, which ranked on PMS Bazaar, was Right Alpha Fund. This is a high momentum strategy, very concentrated, only 10 stocks. So, it is a high risk, high return strategy. This one has given 31% return. It ranked third on PMS Bazaar in November. We also have a hedge strategy, which is momentum stocks along with hedging, right? So this one has also been quite robust, and it is giving very good performance. So I'm going to explain the core basis of all of these strategies in the next few slides. But before we go in, I think we have to talk about, is this the right time to invest? What is the market outlook looking like, right? So let's talk about the key thing that is driving the market right now, which is the FII flows that are coming into the market. You will see that after a few months of decline in FII flows, negative flows, we've seen FIIs coming back to India, and that is very strange because in December typically India sees FII selling, but now FIIs are buying. And why is that happening, right? So number one is that India has shown a very strong economic growth, right? It has outperformed the projections that other analysts had given on growth. India's growth is very strong. The valuations right now, after a few months of selling by the FII, especially on the large cap space, are very attractive. So it is doing well on the valuation side as well. Indian rupee has weakened, and when rupee weakens, it becomes attractive. The equities become attractive for foreign investors. Monetary policy outlook talks about India might see rate cuts happening in the next year, which is attractive for FIIs. And if you guys follow technicals, you will see that the technicals also show a very strong market potential. Another thing is that after the state election results came in, there is a big belief that there will be a lot of political stability in the country, and the economic reform agenda of this government will be continued in the next phase as well. So all of these factors are looking very attractive for investors, and India is getting a lot of foreign flow, which makes us very excited about the potential of the PMS and our ability to generate wealth for our investors. Let's talk about another important thing in the markets, which is the rate hike cycle. So just last week, we saw that the US Fed paused the rate hikes, right? And which would be very exciting for equities, right? So wherever rates are cut, risk assets like emerging market equity stocks start becoming very attractive for investors. So that's what we're seeing right now. If you look at this chart, you will see more and more people are expecting rates to be lower in 2024, 25, 26. So there should be, everybody's expecting the rates to go down starting from the next year, right? And there are a number of factors that are, making people believe that. Number one is, obviously economic data in the global market has improved a lot, right? Which makes the Fed confident that, they can have a, cycle where they start cutting the rates. Secondly, there is a fear that if any further rate hikes happen, there could be recessionary consequences, and the Fed is careful about that. Third is in the times of global uncertainty with, the Ukraine war and the war in Israel, the US Fed doesn't want to escalate the economic situation. So there's a strong probability of a rate cut, and if that happens, that would be a big boost for the Indian equities as well. So all of these factors right now, if you were to talk to me, look like we are going to see a continuation of the bull run in the market for the next few years, which makes strategies that we give out to our clients very attractive. So that was about the market. We are extremely positive about the outlook in the next 3 to 5 years, and we are going to now cover the topic at hand, right, which is factor investing. So see, factor investing, if you were to understand what factor investing means, is that as an investor, I am trying to identify what is the factor that is going to influence the market return. That is why it's called factor investing. You're trying to identify what are the different factors that can impact the market. And the understanding of this approach has evolved, right? So years ago people thought of a portfolio as a thing that moved on its own. But then eventually people understood, okay, there is a market component that the market will impact the stocks in a certain way. But over and above whatever the portfolio manager is doing, what are the active bets the portfolio manager is taking, they will provide you alpha. But as the understanding of the market has evolved over the years, what people have understood is that factor investing, that there are different factors in the market, right? So a momentum investing, or let's say a value investing, is something that the valuation of a stock will always influence its prices. Similarly, the trend that the stock has will always influence the prices. The growth that the stock is showing will always have a impact on the stock's performance. So you can break down a lot of the stock's return potential, any portfolio's return potential, using these factors. And what is left is the alpha. So what we believe is that understanding any factor's performance or any stock's performance basis of a number of these factors, and any incremental alpha that you can generate, uh, and timing these factors can help you generate a consistent returns, right? So now let's talk about, we covered what factor investing is, and I'll go deep into the factors in the next few slides. But let's talk about data-driven investing, right? So everything that Wright Research does is data-driven, right? We let the data and the systems take the decision, and our work is working on those systems, right? And we believe that the data-driven investing methodology has a big advantage, right? The first advantage is that with data-driven investing, you remove any biases, right? So as an investor, you could be biased towards, any stock that you bought, you don't want to sell it because, this is something that I've selected. Sometimes, there can be different sorts of bias. Sometimes you get excited by any stock that's going up and up, and you don't see the valuation before you buy, right? You keep on buying it even though the stock has overvalued. So with data driven investing and setting a set of rules, you can mitigate these biases. Thirdly, with data driven investing, we can cover a lot of data, right? So I don't have to look at only 100 stocks or only 200 stocks. I can cover the whole universe because at the end we have to look at these data sets as data, right? Third is that the speed of analysis can be very fast. So we can run this strategy in a very quick fashion if you have good infrastructure instead of, hours of analysis. Number fourth is that, risk management can be automated. So I have a system, I will take it across different, market scenarios and see how it does. And, if I see that it's not doing well in the bear market, then I can work on the risk management and, make sure that, that rule is built in. And the fifth part is that the performance can be a little bit consistent, right? So, we've looked at it in different scenarios. We know what happens if market goes through any phase, and we can have, we can expect a consistency or, consistency of expectations, right? Now, having talked about all that, let's talk about these factors, right? So I think the core of our presentation is trying to understand what factor investing is. And I have put on a few examples of certain stocks to give you a brief about what do these factors look like, right? So the first factor that we will understand is momentum, right? Momentum means that these investors believe that any trend that has picked up will continue in the future, right? So it is momentum is something that you might have heard in the physics class, right? That there is a momentum that a stock has, which is the force with which which is the acceleration with which it is going through. And in stock market, momentum means just the same. Anything that has picked up a upward pace will continue. Anything that has picked up a downward pace will continue. And that is what a momentum strategy is betting on. So right now, if I were to give you what are momentum stocks, so a stock like BSE, which has seen a very strong performance, or let's say a PFC, is something that you would call a momentum stock. The second important factor, an extremely important factor, is value, right? Value is a strategy which invests into undervalued stock, right? So you will, a simple way to understand is to look at the PE ratios, right? So any stock that has a very low PE ratio means that its price is undervalued compared to its earning, right? And, people will recognize that, the earnings seems to be strong, whereas the price is low. And that's why people start betting on these stocks. So right now I have a couple of examples. Just Talent Angel 1 come up in our value screener. Uh, Another important factor that we look at Wright Research is earning momentum. What that means is how are analysts across India rating that particular stock or expecting how the earnings will be, right? So we all know that, India has a number of strong and, very smart analysts who cover different stocks, and they put out their EPS estimates, their revenue estimates, and a number of estimates, right? And based on these estimates, if they are upgrading a stock, you would see that, the stock starts rallying. If they downgrade a stock, you see that, okay, there's a correction. So how analysts are rating a particular stock is also a very, very important factor that we consider. Now, the fourth interesting factor is quality, right? Quality can be looked at as earning quality, how consistently profitable a company is, how stable the profitability is, how stable their fundamentals are, and that's how you rate a quality company. Another way to look at it is looking at the management and different metrics related to the management that can help us identify quality. The fifth factor that people look at is growth, which is historical growth. Any stock that is growing at a at a good pace, right? In terms of earnings, in terms of revenue, sometimes in terms of dividend, on different metrics, you can rate the growth and invest based on their growth metrics. And then, so here you have Zomato and MRPL that have been picked up in our screener to come up with the growth metric. Sixth, the factor that we'll talk about is the low volatility. Here, investors believe that any stock that has very low risk, doesn't move a lot up and down, will outperform others in the long term. And here we have P&G and we have Gillette in this basket, right? So all of these factors that I've explained, why do people invest into them? Because they believe that each of these factors will outperform in the long term. And that is what we see as well, right? So now with Wright Research, while I've explained to you 6 very popular factors, and obviously, we haven't discovered any of these factors. These factors have been known for decades and decades and decades, right? People have been doing value investing since before I was born. People have been doing momentum investing for a very long time. And what we do is we take these approaches. We, let's say, we decide to do momentum investing. We'll identify different ways to do momentum investing. We'll identify different ways to do value investing, pick up the best performing way to do that, and include that into our basket. So we, in fact, look at more than 10 factor groups from quality, momentum, value, growth, etc., to even some alternative factors. Let's say sentiment. How is sentiment moving? As per the different news articles or filings that come in, sometimes ESG or, corporate governance issue that can be identified from the news. So we, for most of the days as quant researchers, we work a lot on identifying these factors and, trying to optimize a strategy that can work based on these factors, right? So this is about the different factor groups that we work with. Now let's look at the performance, right? So what is very important to note from this chart is that in the long term, in the 10-year period where I plotted this, all the factors are doing better than the market index, right? So a value investor does better than the market in the long term. A growth investor does better than the market in the long term. A momentum investor also does better than the market in the long term. So these are fundamental anomalies in the market. Are, due to the investor behavior, the market is biased in such a way that any stock that's get undervalued is picked up by investors and tends to pick up value. But what you will note from this particular chart is that not all factors work all the time, right? So I would not say that a value investor is somebody who will, do better all the time. Similarly, I won't even say that a momentum investor is someone who would do better all the time, right? What we believe is different factors will work in different scenarios, right? And that is where the tactical allocation comes in. So, we believe that the market goes through distinct phases. There is a bullish phase and there is a bearish phase, right? So the bull phase, you can here identify using these blue lines that, in these markets, the market has been through a bullish market, right? And in the red lines, the market has gone through a correction. Now, the behavior of the market changes dynamically, the market in a bull market is extremely different from how it is in a bear market. In a bull market, you would see that all the maybe small caps are doing well, maybe high momentum stocks are doing well, right? uh, People don't care about stocks being overvalued, and the trend becomes stronger and stronger. So the behavior is totally different. But when the market goes through a bear phase, you will see that people are scared of overvalued stocks. They want safer stocks. They want to be biased towards larger stocks, right? So that's how the behavior changes. So what we believe is that because the behavior of the market changes with these different phases, our investing style, or our allocation should also change with the changing market dynamics. Now, what is important to understand here is that while we understand how the market is today, right? Today, I know that it's a bull market, right? I know last month it was a bull market, and historically I can identify, right? Okay, this was a bull market and this was a bear market. But what is very important is for us to be able to say what happens tomorrow, right? I'm investing, any stocks I buy, I will have to hold it for the next month or so, right? So I have to understand how the scenario is looking like and in the future. So that is where we start using predictive methods, and which is where AI or artificial intelligence comes in. We look at macroeconomic data, we look at some technical indicators, and basis of that we try to identify the trend patterns, or the risk patterns in the market. If the risk looks high, right, if it looks like the market is going into a red zone, then we will start reducing the risk in the strategy. When we start reducing the risk in the strategy, then any of the highly valued strategy, let's say a momentum strategy, will get lower allocation. But when we see that the market is favorable, right, we will increase the risk in the strategy, and momentum starts getting higher allocation. That's how we tactically shift our allocation based on our understanding and our forecast of the market regime. So that was about factor investing, and how do we tactically shift allocation. If you guys want to go in depth about how the predictions in the model work, we've recently published a research paper talking about our regime models that you are welcome to go through with, and reach out to us if you want to know more. uh, Now I will cover what happens within our PMS strategy, which is the right factor fund, right? So in the right factor fund, we are looking, we are looking at the 500 stock universe, top 500 stock universe on the on the NSE, right? We are picking stocks from that universe. So these stocks are fairly liquid. We don't have any micro cap stocks. It is, liquid, small and mid caps and large caps. Uh, and there's a reason for it. We are relying on data, and the data is only available for the liquid stocks, right? That's the reliable data that we have. Um, and with this universe, we picked 20 to 25 stocks to include in our basket, right? And we have a lot of number of, how do we select this? That, we look at these factors, we apply a way through which we are trying to maximize our returns, but we are also looking to reduce the risk and also reduce the cost. So we don't want to trade too much. We don't want to pay a lot of brokerage. So we also try to reduce the cost in the strategy as well, right? And after following these methodologies, we use certain algorithms to do it. We get the optimal allocation. Now, so this is broadly how the strategy works. We rebalance on a monthly basis, not on a specific day in the month, but whenever the model says that it is time to rebalance, we rebalance the portfolio on a monthly basis. We don't trade too much, right? It's not like we're trading every day or every week. It happens once a month, and we tactically shift our allocations, right? If you look at the performance of the strategy, so first I've put across one of our best strategy, which is the alpha fund. You would see that this one has given a very strong performance, right? It has given more than 30% return in last 4 months. This strategy, in fact, started somewhere around 24th of August, right? So it's in fact just nearing 4 months in existence, and across all the historical months, it has done better than the market. November has just December, May. I think large caps are doing a little bit better. So you see a little bit of muted performance, but the returns have been quite robust over the last 4 months. Second strategy, the right factor fund. This is our most popular strategy. So among the 50 crores and more that we have deployed, people have invested the highest in this strategy. So this is a moderate risk strategy. This only has 20 stocks, but our alpha strategy, like I said, only has 10 stocks. So alpha strategy is a high risk strategy, 10 high momentum stocks. So obviously, when the market picks up, it rises at a very sharp pace, which we saw in November, right? But when the market goes through a change, you would see that the alpha has a heightened risk as well. On the other hand, the right factor fund is much more diversified. It has 20 stocks, uh, highly diversified, and it has a different risk and return profile. So you would see again, this strategy has done better than the market across all the months. December is, proving to be very good for this strategy as per the numbers. And like I said, most of our investors invest into right factor fund or the right alpha fund. Now, see, we at Wright Research work through systems, right? So a system that I've created, I can test it across historical scenarios and see how the strategy would have behaved. So we are also able to show you backtested performance, right? So we have been backtested this strategy for 10 years, right? And in the 10 years, what I see is that the returns, the 10-year CAGR numbers looks extremely attractive. But what is also very interesting is that the risk is lower than what the benchmark gives, and drawdowns are also much lower. And obviously these numbers look very, very attractive, but what we have to understand is in the last 10 years, the market has gone through some very sharp bull phases, which has led to high returns coming out of strategies that have high allocation to momentum. If we look at our okay, so if you look at the backtested performance of alpha strategy, you would see that there the returns are in fact even higher. It is, those numbers are little bit high, but the risk is higher there as well. Now let's go a little bit deeper into how allocation in this strategy works, right? So number one is how do we select stocks, right? So I told you about factors, right? So creating a factor strategy is simple, right? So let's say I'm creating a value investing strategy. What I would do is I will assign a value number to different stocks, right? What is the valuation of this stock? I'm able to assign a number to all of these stocks. And at the end of the day, what I would do is I will try to pick the stocks that are showing the highest value, right? That have a lot of value. So my top stocks ranked, I'll pick the valued stocks. But what we'll also do is we'll make sure that it's very diversified. We're not picking stocks from one sector, industry, or business group only. We are diversifying it across the board. And then, that is a value strategy. But within the factor fund, what we're doing is we are allocating to each of these strategies, right? So at any given day, we are looking at how much risk I can take. Is it a bear market or a bull market? It's a bull market. I can take a lot of risk. So you will see the momentum type strategies getting a lot of allocation. But the moment you get into a bear zone, we say now reduce the risk. And if the risk is reduced, you would see gold and bond and all that starts coming, value strategies getting higher allocation, low volatility strategies getting higher allocation. Sometimes, what we'll always see, we'll keep on seeing in the market is a scenario that, we have never seen ever, right? So if you see a scenario that you have never seen, we also have a deallocation policy in place. So if the risk in the market goes beyond a certain level, let's say there's a 10% correction in 2 weeks, it's very sharp. What we'll do is we'll systematically start deallocating from the strategy and moving a little bit into cash. So with a 10% correction, we move 10% to cash, and with every 5% correction, we start moving gradually to cash. And then when the market recovers, we'll start reallocating as well, right? So we have a deallocation policy in place also, along with different risk mitigation philosophies. That's why the strategy does well in a good as well as a volatile market. Now, talking about volatility, let's look at a couple of risk scenarios, right? So if you look at, and these are backtested results, we have live performance for 4 years. I can talk a little bit about advisory strategies also, which have been there in the market for the last 4 years. But as per the backtest, you will see that in March 2020, when the market crashed 40%, the strategy only corrected 15 to 20%, and then very quickly within the month recovered. And this is what, in fact, we saw on our advisory space as well. When the market crashed that much, our strategy did not correct this much because, we had deallocated to bond and gold in the beginning itself. And then with a couple of deallocation, we were able to, constrain the risk. Similarly, last year, you would see that the strategy performance was stronger than the market, even despite all the volatility. Now let's look at comparison of the risk with the benchmark. You would see that the strategy risk tends to be similar or slightly lower than the benchmark in most of the cases. So that was about the risk. Let's talk about returns now. Obviously, because the strategy has a strong momentum component, it tends to perform really well when the market is going through a bull phase, right? So right now you are seeing very strong numbers come out of the momentum linked strategies, and that happens in a good market. But when the market goes through a bearish phase, you would see that the strategy also will give you a muted return. It's an equity strategy, right? You're buying into the stock market. So when the stock market is going through a bear phase, the strategy will also show you muted returns, right? So year on year, it's very tough to predict, right? What happens in the next year, it's very difficult to say. But if you look at any 3 to 5 year horizon, you would see that every 3 or 5 years, the strategy returns continue to remain robust, right? So if you invest for the long term, you can have a stronger expectation. I can be much more confident in giving you your expectations to get from the market. So in every 3 to 5 year horizon, you would see that the strategy is giving fairly decent performance. And that is why when allocating to equity strategy, we should always have a longer term horizon. So we've talked about in detail about how the strategy works. Let's talk about some more details. So the turnover in the strategy, right? How much do we churn and what is the trading cost that we incur, right? So that is also extremely important for us. We put a lot of focus on researching that. And we try to control our turnover less than 250%, right? And that number is highly conservative for a quant strategy, and you incur a very small cost for that. And any holding stock that we hold is held anywhere between 3 years to 3 months, 3 months to 3 years. But majority of the stocks, more than 70, around 70% odd would be short term, and rest will be long term. And we have these expectation numbers in place based on our previous experience in the advisory space, as well as our backtested performance. In terms of our strategy, it is highly diversified. Right now we do have allocation to the finance sector, power finance, capital market, etc. We have allocation to defense, we have allocation to railways, we have allocation to capital goods, banking, FMCG, and a whole mix of cement and a whole mix of stocks. There is a high allocation to small caps right now, but that changes as the market changes. So once large caps come into favor, you would see that the allocation to large caps will slowly increase. It's not like we're going to sell small caps and move to large caps, but slowly you would see that the strategy starts allocating more towards large caps. So this is highly dynamic how the strategy allocates. And yeah, I think that is pretty much it. If you guys want to look at this and reach out, you can email us at pms.sales@wrightresearch.in. And I think with that, I will end my presentation, and I'll let Akshara take over, and we can go into the Q&A.
Yeah, thank you, ma'am. That was a very brief one, indeed. And of course, while of course, when I was when you were putting up your PPT, I had this question: when your quant-driven strategy is completely AI-driven, more like arithmetic-driven, and there is no much of human interaction to the strategy. But then why would I invest in it? How do you even differentiate between the passive fund and this fund?
Right. So see, it is a highly active strategy, right? And the active component is built into the strategy, right? A passive fund, typically ranks stocks based on market cap and invest into the larger cap stocks. The larger market cap stocks in a particular category, where what we do is that, we are trying to identify factors in different ways. So even when we're doing momentum, we don't stick with one number. We try to include a number of strategies, create a mix of factors. And when we do tactical allocation, we are also actively shifting between these factors, right?
Okay.
So the strategy is highly dynamic in that way. It's not, passive in any sense. And what we also do is we also try to, we do put in a lot of effort, right? So it's not like, the strategy runs on its own. We keep on researching and reevaluating how we are approaching different factors, how we're approaching risk, and, improvising on that.
Okay. So let me take the question from audience as well. Someone from the name N. Okay. Could you kindly share PMS? First thing, only fixed fee pricing and expected CAGR returns.
Mhm.
And how could you move all cash, etc. When market suddenly starts crashing or moving to liquid Bs or gold.
Right, right. So in terms of fees, the fixed fee is at around 1.5%. And, we also have variable fees, which is with a 10% hurdle and 15% sharing over that, or you can use BSE 500 as a hurdle. So no fixed fee, only performance sharing over the BSE 500. Second question was, how do you move to cash and gold?
Yeah.
Yeah. So see, how we do that is that, like I said, we're trying to forecast the risk in the market, right? When we see that the risk is looking high, then we don't say now move to gold. What we tell, what we have, the rule in the strategy is reduce the risk that you are taking. When the strategy reduces the risk target, then automatically only the lower risk strategies, or assets with lower risk will start getting weight. So a gold or a bond has a lower risk, starts getting weight, and the riskier strategies don't get that much of a weight. uh, Fourth thing that I think you asked about moving to liquid Bs also. So
Yeah.
when we move to liquid Bs, we move to cash where we get interest. And on that side, we again we have a deallocation that's very simple. That on any sharp correction, we'll deallocate a certain percentage, and as the correction accelerates, we also start accelerating our deallocation. But the moment the correction is over and there is a recovery, we will start reallocating, right? And that works well, as you've seen in the last few years.
Okay. And the other question from SB was, what's the source of the chart data in the chart? Like all the charts that you showed.
Yes. So the source is, like I said, that we work with a system and we have a lot of data from very high quality data sources, right? And we backtest our systems on those data sets, right? So while, very clearly, we only have 4 months of performance on the PMS, but we have taken our system historically and tested it and seen how the potential returns would be. A lot of work, Akshara, honestly, that we do is on the data clarity. We have to make sure that the data is cleanest. If let's say I'm looking at the strategy 5 years ago, then my 500 stock universe has to be based on that year, not this year, because otherwise there would be a bias. We have to make sure that the data is extremely clean for that year, so which is the effort that we put in and work on in getting the strategy backtested.
Okay, the next question I would like to move on to was, uh, would you also add derivatives to manage the drawdowns instead of moving to cash? In theoretical, you
Yes.
reach 100% cash.
Yeah. No, so in our hedged strategy, the second strategy, which is right factor fund hedged, which is on PMS Bazaar, you would see that we in fact have hedging in place. So when the risk in the market is, when there is a scenario where there is risk in the market, instead of moving to cash, we'll deallocate and we'll deploy the money into put options to hedge this strategy. Unfortunately, Akshay, in the last 4 years, last 4 months, we haven't had an opportunity to hedge. But I'm sure whenever that opportunity is there, we'll deploy and hedge to mitigate that risk.
Because last 4 months, I think market was all positive and
Yeah, yeah,
all on a bull run.
yeah, yeah.
So, and when your strategy has given good returns, so how if you can't expect market to be always bullish.
Definitely.
So there'll be a bearish side in the market as well. So how would this factor fund or alpha fund, how will that perform? Any
Yes. So
predictive analysis that you
right.
have?
Right. Yeah, yeah. So definitely. So like I said, when the market goes through a bearish phase, whenever we see that there is a probability of a bearish phase, we reduce the risk in the strategy, right? So the behavior of the strategy totally changes as that expectation changes. You would see that the allocation to safer stocks increases. You would see larger caps coming in. You would see, like I said, bond, gold, and all of these coming in. You will see lower volatility stocks coming in, and the risk in the strategy goes lower. So in those phases, you would see that our like I said, that with tactical allocation is that's what it means, that tactically we are shifting our allocation based on our understanding of the market.
Okay, and next question from N was like, markets are at all-time high, and will you first put in SGB or liquid or balanced funds, and then start pulling into 100% equity over 6 months?
So I think we do it differently for different people. See, like I said, very clearly that cash calls are built into the strategy, right? So the strategy tells me when to get into cash, right? And it is built, so our allocations, when people let us invest. So over the last 4 months, Akshara, to be honest, everybody has, all throughout those 4 months, people have asked, we are at a top, we are at a high, should we invest? But
Yeah.
for most of our clients, we have allocated in the beginning. For certain clients, who give us instructions, right? Let's not deploy in one go, let's stagger it. We stagger it, right? We deploy, let's say, in 4 chunks or 5 chunks, or, depending on how the client says. Sometimes, what happens is that we expect, there's a high risk in the strategy. And when that happens, we expect a rebalance to come in, right? So if we expect a rebalance to come in and certain stocks to go out, so we will not allocate on day one, right? We can allocate, let's say 60-70%. Whatever we expect to go out, we don't buy it for the client. We'll wait for the next rebalance and buy it then. So we try to be definitely we allocate as per our expectations, and not necessarily 100% on day one.
Yeah, that's true.
Mm.
And next question from Abhishek was that how do you see IT service sector performing next year or two in a constant falling interest rate around the world?
No, definitely. See, with the falling interest rates, people expect the US economy to recover. So Indian IT gets lots of orders from the US market, and people do expect that to recover. But we've not seen a very clear sign of it just yet, right? So as per expectations, IT sector is rising, right? People expect this to happen, but the deal wins haven't come yet, right? And people expect that to happen. I think once there is a very clear indication that that the recovery is happening on the IT sector's market, I would expect IT sector to have a great run. So yeah, I think the outlook is extremely positive for the next couple of years. I think with the recovery that is expected, IT sector would do well. But we have to watch. So there is not a clear indication just yet that has started.
Thank you, ma'am. And next question from Vaibhav shall be, will there be any allocation to every factor in every cycle? Or so if there are any 10 factors that play, and each factor every time will have two stocks. So weights may vary.
No. So we don't do that. See, there are certain multi-factor funds. What they will do is, they have a defined way, 30% allocation to this factor, 30% to this and this. But we don't do that. We let the system decide. So in a good market, you would see that momentum might have a 60% allocation, and, growth has some allocation, and, maybe value has some small allocation. But in a bearish market, the momentum allocation goes down, growth gets some, and, value gets higher, low volatility gets higher. So there is no set rule, today we have to get, these stocks from these factors. We change our factor allocation based on the market scenario.
When you talk about this multi-factor thing, so yours is the multi-factor model. So how do you manage the factor interactions or correlations within the multi-factor model?
Right. So see, Akshara, what is very interesting is that these factors have been chosen. Again, I would never claim that I have chosen the factor groups. These factors have been chosen so that they represent different things, right? So a momentum strategy is extremely different from a value strategy.
Yeah.
And it's extremely different from a growth strategy, and it is extremely different from a low volatility strategy, right? So all of these are very distinct things which are uncorrelated in itself, right? But we do have ways in which we try to even reduce the correlation, and so we have metrics for that as well.
So what are the metrics? If you could tell us.
No, so see, when we are creating these factors, I'll have to go a little bit into the maths, right?
Okay.
Yeah, but you can you can just remove the uncorrelated. Let's say I have a good value strategy, so I will just use when I'm creating a momentum strategy, I'll just use the exposure that is uncorrelated to value. So that's based on the thing.
Okay, that's completely arithmetic driven. That's what you mean.
Yeah.
That's true. And what is the ideal investment horizon for this particular strategy, and who's the typical customer for this?
Right. So I would say, yeah, definitely. So what I would say is that, your horizon should always be long term, where you're investing in this strategy. So we get this question a lot. And we tell people that, this strategy can be a big chunk of your equity allocation, right? But, always have a long-term horizon, right? So right now we've given very good return to our investors in the last 4 months, right? But as the market scenario, it like obviously it will not give you very high returns all the time, right? There will be a scenario when the returns will be muted, there will be a scenario when the returns will be very high. But if you look at the pattern that the market follows, you would see that if you invest for the longer term, 3 to 5 years, then you can expect the strategy to give you a good return all the time, right? Like in the most of the times, right? So always have a long-term horizon, always have a horizon of more than 3 years is what I would say. If you get a very good return in the first year, then you are lucky, but always have a long-term horizon.
Okay.
The
So
typical investor profile, if I were to talk to you about Akshara, we get a lot of interest coming from people, who trust systems. Sometimes people who coming from technical backgrounds, we have a fair bit of those folks. We have people, with no technical background, but who understand that, we are uh, following a systematic approach. We are following a data-driven approach. We are not speculating. We are not going with any bias. So that's why they trust us and come to us. We have people who are nearing retirement who are coming to us, and we have larger uh, investors and institutions also looking.
so people with different financial goals.
Yeah, definitely,
Right.
definitely.
So, okay. And how transparent is your funds methodology and decision-making process for a factor selection and allocation?
Right. So I think I've transparently told you, broadly what we do, right? It's extremely transparent. So, while I could have also said, it's an AI strategy and factors and it's a black box, right? That is not the approach we follow, right? People think of quant as a black box, but we think that, we can be highly transparent and, more transparent than a traditional strategy, right? So today, if an investor asks me, why is this stock in your portfolio? I can, very clearly tell that, we are taking in allocation to momentum, which is why this stock is selected, and which is because the market is going through this phase, right? So it's
Okay.
extremely transparent, and I think more transparent than other strategies.
Okay, so moving on to the question from Mr. Joshi was that, can you please comment on your broader team and their equity experience? So it's an AI-driven strategy. He wants to know more about your team now.
No, definitely. So we have around 13 people in our team right now. It's a growing team, right? We are adding more folks within our team. We obviously have a lot of people working on data and systems and quant. So our quant research and investment team is quite strong, 3 to 5 people, people coming from IIT Kanpur background and from ISB and all of these places. We do have people who are talking to customers, who get a lot of love from our customers. We are trying to build a stronger customer relationship team, and obviously, there's a lot of tech and data that's involved. So we have a 5-member strong tech team as well.
Yeah, great. And the second, I'll move to the next question from Anurag Singh was that he has a couple of questions to ask. At what AUM would you think that would be able to invest in small caps before the impact cost overwhelms the additional
Yeah, yeah.
returns?
So that's a very interesting question. So first thing I told you was that, we do invest into small caps, but, mostly stocks with more than 5,000 crores in AUM, right? Because data for very, very small stocks is not highly available or highly reliable, right? That's the challenge. So we don't include very small stocks. So any stock that we're covering right now is around more than 5,000 crores in the market cap, and that is highly liquid in most of the cases. And I see that, until unless, our AUM is at 50 crores right now, I think after we, let's say, touch 1,000 crores or so, is when the illiquidity concerns will come into this strategy. But even so, we are already working on, making sure that we have all the checks and balances in making sure that the illiquidity constraint is there in place, and a lot of attribution to make sure that that impact is not happening. And another thing is, Akshar, that we work with even execution right from the start. We were only done through algorithms. We use slicing algorithms, execution, trying to slice large orders into smaller chunks, working with how the volume in the market is to get the best prices, right? So I think that is something that has always been in our DNA, because I have worked a lot on execution algorithms in my life, in my previous jobs also. So with that, we also always make sure that, our impact costs are also lower from the market.
With saying that, I have one question to ask. Like, you won't get to meet any management or to go and talk about, for the stock as well. So, do you think is it a drawback for a quant-driven
No, no. So
strategy?
see, we do try to attend management calls, and see, always uh, after the stock has been selected from the system, we have a level of checks on the illiquidity, any recent news, etc. And even though it's a system, right, and we use it because it's reliable, but we do our own due diligence and our own analysis of the market to keep up on the pace. And see, again, we have built a system. I'm not saying that it knows 100%, right? Is it missing something? Is it missing a factor that has not been included? So various times we'll have had to evaluate and bring that in, right? So let's say when the inflation rose, we had to identify stocks that are impacted based on inflation, or when there was a lot of correction in the US, we had to identify stocks that have that exposure. We've had to include, let's say, stocks that are seeing a lot of selling from promoters, right? Those type of factors is something that we keep on evaluating, and it always helps to see what companies are doing, what their outlook is, to understand the scenario better, right?
Yeah, that's true. And moving to the second question from Anurag was that on regime model, how do you handle the revisions and delays in release of the macroeconomic data? For example, GDP data released with a delay of 2 months, and it is revised up to an year after getting released.
Right, right. Yeah, I think that's a very good question. So we work with the data that comes at a delay, and we published a paper on this where we looked at a bunch of data, typically data that is of a annual frequency that comes with a 1 year period is not that useful for us. Data that comes at a much more frequent frequency, right? So let's say data that is released every month, even though with a delay, it has a lot of predictive power. Similarly, you do have active indicators, let's say the yields, right? They are
Mhm.
present on a daily basis. How the currency rate is changing is present on a daily basis. A lot of other data set is present on a weekly basis as well. So there's a whole range of data sets. There is a little bit of delay, but we worked on delay data to validate our model, and it gives a strong result. And another thing is that the revisions, right, which you talked about, which is again that bias could be a little bit there in the data, because we use source it from a data set that has the revised values. And but yeah, I think the data quality in India is improving, so I hope that
Mhm.
that gets better, right?
That's and next question from Sachin is that in current situation, when market is at top or for a few allocation in your PMS, what would be your strategy? And also see the top five holdings in your allocation are also at approx yearly peak. So how could the allocation for the new investment look like now?
No, definitely. See, we are, like I said in the beginning of the presentation, we talked about our outlook from the market. It continues to be positive, right? I think, even a technical analyst will tell you that, the setup is positive. People analyzing the growth will tell you the setup is positive. We might see, slight corrections happen here and there, but the longer term outlook remains quite positive, especially in the next couple of years. And that's why we are allocating right now as well. And we totally believe that whenever there's a time to rebalance, certain stocks will go out and come in, and we'll do it on a timely fashion, right? So we let that happen as the the strategy has been built.
Like any specific AI techniques such as KNN or random forest that you use? Also,
No,
please share the
definitely.
result.
No,
Yeah.
definitely. We use a random forest, KNN, boosting techniques, gradient boosting, and all of this. And there's a lot of, while we use all of these systems, there is a huge focus on making sure that the results are reliable. So we test it across time. We make sure that our errors in the testing set are similar to the errors in the training set. There is no bias in that way. There's no look ahead bias. So a lot of research goes around in making sure that these systems are reliable.
The next question, Rushi, was like, what is the logic of funds market regime to define allocation between the factors?
Right. So see, market regime, see, it's very intuitive. It's very simple to understand, right? That as an investor, when you see that in the current market, you would be, if you were to allocate, you would say, give me allocation to the alpha fund. It's giving so much good returns, it has a lot of return potential. But let's say the market was volatile, right? You would say that, give me slightly safer allocation, right? I'm seeing a lot of risk. I would be happy to allocate to a slightly lower risk strategy because at least it will not have a lot of risk, right? So that's an intuitive thing, and that is what we have built through the system, right? That we're looking at the market scenario based on the regime model, and when the risk is low, then we can let allocate to any strategy that is giving the best performance. But when the risk is high, then we have to reduce the risk in the system as well, right? So it's a very intuitive sort of a setup.
Okay. And next one from Meet was that when you consider risk in the market, do you consider the risk of benchmark or increase the risk the data invest in the portfolio?
Right. So we are looking at the risk in the benchmark, right, or the broader index to identify the regimes. But when we are deallocating, then we are looking at the correction that the strategy is seeing, right?
Okay, the next question, okay, it's more like a compliment. It's one from Bapi was that thanks for the wonderful presentation. Quant investing is an existing long back, wondering what AI competitive advantage you bring in using quantitative model. Right fund strategy highlighted in the presentation. Is it a completely AI driven? And what's a back tested time series return? I think
Right.
you've already shared it.
No, thanks a lot. I think, see, quantitative methods have been available for ages. I think people don't do it very extensively in India, and we are following this approach and that makes us a little bit unique. It's not purely AI driven for sure. There is component of machine learning at different places, right? So like I said, when we're trying to look at risk, we try to forecast it, right? I can't just believe what happened yesterday and, expect that to continue all the time. We are trying to forecast how the risk is going to look like. We try to look at the predictive power of different factors and, use that as well. But it's systematic, but not pure AI, right? There's no chat GPT which is taking the decisions. Uh, but yeah, and we have researchers who actually work and look at different metrics and try to see if how we can improve the system further as well, right?
So when you talk about forecast, there's one more question from Subramaniam that what is your prediction in market till May 2024?
See, that's a very, very difficult question because the elections are going to come then. We try to forecast 1 month forward. The outlook remains positive right now. And, these predictions change, and whenever they change, we take an action. Obviously, I think with the elections coming in, we've done some analysis which says that, there could be a little bit of volatility in small caps and, might be better to allocate to mid and large caps. And I think that's the outlook that we sort of have. But I think right now it remains extremely positive how the movement is going, right? People are seeing a continuation of the current policies. So, we could see a very positive trend as well.
Yeah. Second, another question from Vinod was that how does the proposed PMS compared with the quant-based mutual fund? I think it's a very common question.
Yeah, I get this question every time because see, the quant mutual fund has named itself quant, right? But they have a different sort of a quantitative philosophy. So you see, they have different sort of portfolios. Mutual funds follow different rules. There is a large cap mutual fund which invests in large cap. There is a small cap mutual fund that invests in small caps, along with a bunch of SEBI rules. Ours is a unique strategy that allocates to multiple factors. It's flexi cap, it is tactical and active. So approaches are different, but yeah, definitely they have a quantitative philosophy. They do allocate a lot to momentum factor as well, like I've heard. But yeah, I think the approaches within the quant space can also be very, very unique, right?
Yeah. And the question from Kaushik was like, good evening. Like you said, if momentum is going down, you did mention that the allocation is moved towards a different option. So how does the allocation logic is triggered, whether that it is automated and AI suggested?
Yeah, it is all automated, right? It is all system driven. So this regime model that I talked to you about, it will tell us that, and it will tell us, okay, now today the regime has shifted towards a bearish zone, right? Or the regime has shifted toward a bullish zone. So that signal will come from the model. And then again, another part of the system will take that input. Okay, the regime has shifted, so I reduce my risk. And if I reduce the risk, then the other strategies that have lower risk start getting higher allocation, and the high risk stock start getting lower allocation. So that is a thing that comes from the system only.
And the question from my Shah is that, is there any stop loss applied to any of the stocks, or generally the portfolio is reviewed on a monthly rest period?
Yes, so there is no specific stop loss as such that we apply. But yeah, like, if very simple way to understand is you're picking momentum stocks, right? And let's say you're trying to create 20 stock portfolio. Today, I'm picking the top 20 stocks. If I look at it next month, any stock that might have corrected would have gone down from the top 20 list, and automatically it goes out, or, any other stock would come in. So we don't have specific rules of stop loss, but we typically see that, that happen on its own.
Okay, and the next question is that, is your strategy, in your strategy, it is said that tech system decides, but the system is depend on how the programs are devised. Namely, what are the parameters that are present? The selection of parameters are dependent on the individual options. Also, what are the AI used in the programs, and how does the algorithm work?
No, definitely. See, these systems are devised by us, and definitely, but yeah, see, what we do is, that, it's not like an idea I have today and I start investing it tomorrow. What we do is, this idea we validate across historical data. We see what the best parameter would have worked on historical data, see how it um, worked in sample, or when we are doing the testing, and out of sample when it sees new data, and then we only take that system out, right? So we definitely, while the idea might come from us, we validate it with a lot of data before we bring out that system. And like I said again, the AI or forecasting techniques are used in forecasting the risk, sometimes in forecasting the predictive power of different factors as well.
And of course, and all three funds, whichever you said from Wright, was new to market. And how do you see it positioning itself among the peers in the industry?
No, I think these are new funds on the PMS space. They're doing well. And we've done, in fact, we've been running same methodologies in the advisory setup for last 4.5 years. And last 4.5 years, you guys can check us on small case and all that, have been tremendous for those strategies. They have ranked on the top among different comparisons across the board. On the advisory space, 15,000 people, in fact, invest in our advisory strategy, where 400 crores of assets are managed. And, now with the PMS, I think we can do much more. And yeah, I think, so that's why we are confident, right? So when we started 4.5 years ago, we again had a back test, and which we relied on. And, with now again, we're coming up with the same way.
I think with that question, we have come to the end of the session. And of course, there are a lot of questions which is not answered. So I would request all of them to put their questions on events at PMS Bazaar. And there were few questions who they wanted the PPT also. They want to have the access of the PPT that you just showed, because it was very...
Okay, this presentation is something I created for this event, but all our previous presentations are in fact on our website, and you guys can download it from there as well.
That's great. So I would, the questions which are not answered, please, I would request everyone to put them on events at PMS Bazaar, and I will get them answered individually. I would like to thank your time, and for the, for enlightening us all for this 1 hour. In spite they've just passed 6 minutes from the originally mentioned time, but still.
No, it is my pleasure, Akshara, and thanks a lot for everybody for coming in. And I hope you guys have a great weekend, and a great time in the market ahead. And please do go and check out our PMS strategies. I'm sure you guys will find something that could be interesting for you.
Thank you all.